Good morning, everyone. Thank you for joining us this sunny Oregon day in January of 2025. So, first seminar of the year. Hope everyone's excited for a good one. Everybody, the indications are that 2025 is going to be better than 2024, which I'm very happy about. And I guess what I'd like to say is that's coming a source from a couple of different big real estate firms we do a lot of work with. We did a legislative update last week with CCIM, our Oregon Southwest Washington chapter. We're blessed to have Daniel Wagner of Inland Private Capital spoke in the legislative update there. And I guess the biggest thing is that it sort of appears at this moment that 1031 is not in the crosshairs of anything, which is sure nice. For those of you out there that deal with residential properties, you're probably very aware of the state and local tax exemptions that were put in place in 2017 with Trump's tax reform then. And that $10,000 cap, that is by every indication going to be increasing. And we were concerned that the cost of that increase, anytime they look at something like that, the politicians have to look at the quote unquote pay-fors, and one of the pay-fors was potentially capping annual deductions at $1031.5 million per person per year, which obviously would not be a good trade-off. Imagine, oh, gee, we get an extra SALT goes from 10 to 20, but we now have a cap on 1031 deferral. I mean, who would make that decision to do that? I mean, if you're really a thinking person. So looks like things at this moment are in good stead. We won't know until the actual measures are put forth what Trump does with those 2017 the extensions on that. The sunsetting of all of that is this year. So whether we're talking the QOZs, we're looking to see what happens with opportunity zones, qualified opportunity zones, looking at what's going to happen with the SALT stuff, the corporate taxes, all those things. And obviously we just don't have any news on those fronts right now, but it looks a lot better than it did a couple months ago with the election and what was sort of being put forth from the 2024 party platform with that would have done everything from cap 1031.5 million, increase corporate tax rates, elimination of stepped up basis, a variety of different things. So everybody's looking at a positive nature. Today we're going to talk about 1031 basics, and really the thing is this code's over 100 years old at this point. I'm David Moore. I've been in the business since 1991. My brother and I, Tom, started Equity Advantage in actually our fiscal year, our start date was 10/31/91. So, we had a lot of fun through the years with that stuff. But, we got into it from the application side. We were using 1031 exchanges to buy and sell our own properties. And we were blessed to have a mentor that was an early adopter of the 1031 exchange process from a practice perspective. He had a commercial brokerage, but also he started what was in the 80s the largest exchange company in the business too. So, and it's sort of funny to me because if I go through, for example, the trade organization for 1031s, the Federation of Exchange Combinators, if I go through the member list there, or maybe I should say the people that are managing a variety of firms coast to coast, there are a lot of the people that worked at the old firm with Starker Services. So it's sort of fun to look back at that stuff and have that as roots. So anyway, coming at it from the application side, you sort of have a tendency to look at things totally different. We typically look at the thing and we want to make sure that the exchange is something that works for people, and don't just do the transaction because you're kicking the ball down the road. It is tax deferral. It's sort of like an IRA for real estate, for example. And it's sort of interesting to me because Wall Street world sort of complains, well, gee, we don't have 1031. Well, they also don't mention, well, they've got IRA and 401k funds to the tune of trillions of dollars there. So really you're in a situation where we are looking at stocks, bonds, that stuff. Typically, you're looking at IRAs, 401k plans, and that's a tax deferral mechanism there. Everything you're doing with it, the nice thing about the Wall Street world with IRAs and 401k plans, you don't have timelines, things happen. It's just all total tax deferral until at some point you're looking at taking a distribution of those funds and then paying the taxes on those distributions. Now, understand, today I've got my 1031 hat, Equity Advantage, 1031exchange.com, but I also, we work with self-directed retirement accounts, and we've been doing that since the 2000s, let's say, and that's a very nice compliment for us, because that business evolved out of the 1031 business, because people kept coming to us and saying, hey, I want to use IRA 401k funds to go buy real estate. I understand you can do that. How do you do that? So we put IRA Advantage together back then, and that was really a result of our clients wanting to do this stuff and wanting more information on it, not having a source to it. So whether you're looking at taking and using IRA 401k funds to buy real estate, make loans, buy notes, do a business startup, for example, I've got a slide at the end talking about a rollover business startup. We can help you with that. If we're talking about tax money and in real estate, we're going to be looking at Section 1031. It is actually possible to combine 1031 funds and IRA 401k funds into common investments. And you can do that a couple different ways, either tenancy in common or as common members of a limited liability company. The common membership in an LLC doesn't apply to 1031 money coming in, combining with IRA or 401k funds. But if we're just looking at pulling money out of your pocket to combine personal money and plan money into a common investment, that can be looked at either in a 1031 or not 1031 context, but either tenancy in common or as common members of an LLC. And there's really no best way to do it. It's sort of a question of what you've got, what you're using, what your end game is with that. And then we're going to be looking at that. Now, either way, I just want to stress, and a lot of people, we spend a lot of time these days, for example, talking about Delaware statutory trusts. And that's just a result of our clients going in that direction. We don't sell investments. We don't give investment advice, whether we're talking the IRA 401k world or the 1031 world. If we're looking at 1031s, you're just paying us a fee, an exchange company. You're just paying us a fee to take your sale and purchase and turn it into an exchange. And really, it's almost that easy these days. You can literally sell what you don't want, buy what you do want, and you're paying us a fee to turn that sale and purchase into an exchange. If we're looking at IRA 401k funds, we, once again, don't sell investments or provide investment advice. We provide the investment conduit, the structure that allows you, the investment vehicle that allows you to go do what you want to do. And so I'm going to put that out to you if you're shopping exchange companies, or even if, let's say, you're in an exchange with another company, you're not getting answers on something, please don't hesitate to reach out and ask us a question. We're going to approach it and say, one, we want to make sure that if you're coming to us with a new transaction, I want to make sure that, one, the exchange makes sense. The opportunity cost of the exchange is you've got 45 days from settlement to ID what you want to buy, to find it, and 180 days total time to close on that thing. Now, we're in January of 2025. So if you closed a 1031 late last year, let's say October, November, December, especially when you get to November, December, you're in a situation where your 180th day is going to be pushed past maybe potentially the April 15th date for tax return. Do not file a tax return until you've completed the exchange. If you're bumping up against the 15th of April and you haven't completed the transaction, file an extension so you can complete the transaction, because if you don't, you've terminated your transaction effectively. And that's something that if you look at the fine print at 1031, it says you've got 45 days from settlement of the relinquished property to ID what you'd like to acquire. You've got 180 days or the due date of the tax return to complete the transaction. So that's what I'm saying, late year transactions, make sure you don't file a return prior to completing that transaction. Now, if we're doing a reverse exchange, a delayed, we sell first, buy later, or reverse, we're going to buy first, sell later. And this unfortunately has been a problem in the last year or so, couple of years, when we have a tighter market. People will say, well, gee, my relinquished property, my sale of the property that's going away blew up. I still want to buy this replacement property. And someone says, well, gee, just go ahead and buy it, and then you can do it in a reverse when you sell the relinquished property. That does not work. The exchange has to be structured. You cannot legally own the new and old property simultaneously. So if you're in a situation where you're all set, you've timed the transaction, you're on the call today, and you say, hey, gee, David says timing is the most critical deal. I'm going to say, if you list a property, get an offer, cash offer, they want to close it next week. If you don't know where you're going to go, you might accept the offer, but you're not going to accept the fact that it closes next week. Ask for the time you feel you need. On the other hand, if let's say that sale blows up and you've tied up the replacement property and you still want to buy it and your relinquished went away, we can do that deal via reverse, but you cannot close on that property and then engage us later. So before you ever close a property, whether it's on a sale side or a buy side, make sure that the exchange is structured if that's what you want to do. All right, I'll say that again. If you sell a property and it's not structured as an exchange, even if you never touch the money, if you have actual or constructive receipt, you're going to have tax exposure on that transaction. On the other hand, if we buy a property before let's say you buy a property prior to anything else selling, if it was structured as a reverse exchange and we're involved at settlement, then that can be used as a replacement in a reverse exchange. But if you've closed on it, you own it, you cannot go back and then turn that transaction into a reverse exchange. So make sure that you're asking the questions, that the most important issue in any exchange is always going to be time, and ask the questions up front. The only question that's a dumb one is the one you don't ask. And if you were a scuba diver and if you've been on our classes before, you can hear me talk about this stuff. If there's a problem on a dive and you're 100 feet underwater, let's say you see something that spooks you, the golden rule is stop. Okay, don't just bolt to the surface. You're going to have a problem there. So the same thing's going to apply to a real estate transaction. Do not get forced into a closing that you're not ready for. Put your foot on the brakes, wait, step back, make sure you understand what the repercussions of doing different things are and the timing that's involved with all this. But it's your transaction, it's your money. And if you look at this cover slide, we like to say you've worked hard for your money, we're going to work hard to keep it yours. And this is not a tax or legal decision, it's purely an investment decision. The opportunity cost of the 1031 is you've only got 45 days from settlement to find what you want, 180 days to get it done. So if you're looking at sheltering a small amount of gain, maybe you're better off to just take the money, pay the tax, and have all the time in the world to go buy what you want to buy. I have never in a situation, well, I shouldn't say I'm never in a situation, I will never put myself in a situation where I'm trying to decide at what level an exchange makes sense or ceases to make sense for my clients. I've got clients through the years where they flat out refuse to pay tax on $5,000, let's say, and I've got people that say, well, gee, my tax, it's only 800 grand, for example, in one case. It's not worth doing the exchange. So everybody's going to have their own pain threshold. And really your job is to understand on a sale what the tax liability is going to be. Do you want to pay the tax? Can you pay the tax? And what are your options? And that's where 1031 comes in. 1031 is not a mystery at this point. Like I said, it's over 100 years old. And we're going to really be there helping you get out of what you don't want into what you do want. The biggest issue with all of it is going to be time. Now, why do we look at an exchange, right? As I said earlier, it's not a tax or legal decision, escrowing decision. It's purely an investment decision. When you list a property, contemplate selling a property, first thing you're going to do is march over to your tax people and say, hey, what's my tax consequence on a disposition of this property? Okay, that's number one, because if you don't know, how are you going to make that right decision? What do you know about that opportunity cost if you don't know what the tax liability is going to be? As I said, 1031 is sort of like an IRA for real estate. The reason you look at an exchange is every dollar you save, why would you pay a tax you don't have to? And I remember back in 1991, there was a guy in a seminar. I said, well, look, we live in America. America needs taxes. It's patriotic to pay taxes. Well, think about this. If you continue to do exchange, every dollar you defer and gain gives you 2, 3, 4 more to reinvest if you're looking at leverage. And think about how that snowballs during your life. Now, if you want to pay tax, think about how much more you can pay if you want to pay it at the end of the day, if you're just deferring via 1031 and someday you decide to pay the tax. Now, on the other hand, you're saying, well, gee, David, if I'm going to have to pay the tax, what's the old saying? The only sureties in life are death and taxes, right? So So if we're looking at a situation, I've had people say, well, I'm going to have to pay the tax at some point anyway. Why not pay it today? Well, for all these reasons, if you want to take that argument, you've got an IRA 401k plan, how can you apply that argument to 1031 and not apply it to your IRA 401k? It's pretty much universally agreed that tax deferral is a good thing. And the best thing about it in today's world, like I started off saying, we had a number of measures that we're not looking at losing at this point where we potentially were a few months ago. One of them was a stepped up basis. So there's, in the exchange world, what people will do, a common strategy is you swap till you drop. So you exchange throughout your life. When you become an angel, your heirs get a stepped up basis, current market value. They could turn the next day and sell with no tax consequence. That's the way the law is today. Once again, it's January of 2025. We don't know what Trump's going to do yet with his, with his proposals. But at this point in time, it looks like stepped up basis is currently something that's available and there. And there's a variety of ways to take advantage of that utilizing Section 1031. So once again, why do it? Why pay a tax that you don't have to? Every dollar you save, you got 2, 3, 4 more to reinvest. And you think about one exchange and how much further it puts you into the future as far as your retirement goals. So why real estate today? What's the old saying about hard times? Tangible assets are the ultimate inflationary hedge. And people typically, when they're looking at, let's say, I'm going to put my IRA 401k hat on again real quick. If I'm looking at that space, if you talk to a financial advisor, typically they're probably going to look at tangible asset as far as gold, silver, palladium, something like that, right? Precious metals is the common thing. Well, precious metals, you're still betting that the thing's going to go up. Something's got to drive it up to make you realize the benefit there. And the other issue with those things is if you look at obviously a quoted price on that stuff is you're going to pay that when you buy it, but when you go to sell it, you got to understand what your actual net is on that. So back to my comment on selling a piece of property, if you're contemplating a sale, talk to your broker, find out, get a net sheet from them, understand what you're going to be looking at, not the gross sales price, but let's say an adjusted sales price. You're going to take those numbers, go to your tax people, and you're going to figure out what your potential tax obligation is going to be, and then you decide whether you want to pay the tax. But that's that primary thing. Now, and once again, I'll say having tax exposure is one thing, taxes owed is another. So I would say one of the most important people in your life in today's world is your good tax people, because you want people that are working for you. Don't look at what their cost is to you. Look at the net cost when they've gotten in your world, and don't use them April 5th. Obviously use them before April 15th, but don't wait till then to do it. Talk to them pre-year's end. If you've got financial advisors, let's say you've realized gains on the disposition of a property, that's tax exposure. Well, maybe you got losses somewhere else to offset those gains. So yeah, exposure is one thing, taxes owed is another, and you're going to have that team of people. I'm going to say good tax people are critical. If we're talking real estate, good brokers, people that are going to really represent you and your needs and understand your needs and help you get through the investment life of all of these investments. So when you're buying something, what am I going to make? How am I going to make it? When am I going to make it? And work those investment plans. Good title escrow people, okay? If you're doing real estate transactions, we all have escrow people we like to work with. And I would say good ones are just priceless. I mean, they're very important in that situation. Finance people, property managers, good tax and legal people, people you're paying to put a position on something or paying for information, not paying them to learn about these things. And then I'm going to put ourselves, Equity Advantage or IRA Advantage, on that team, because you want to pay people that are going to help you get where you want to go. I mean, there's lots of people in the exchange world today. They're just going to hold your money. You close the deal, they're going to accommodate the transaction. They don't really care, what you're trying to do. They're just going to say, hey, give me your contact information, escrow, and we're going to put this together. Use us for huge. All right. Well, that's really not what 1031 is about. 1031 is about maximizing your return on investment, getting you out of things that sort of have been exhausted and move forward into it. And the 1031s, that conduit allows you to get those things done. Why real estate today? Cash flow, right? If the thing doesn't happen, you're not like precious metals, you're betting it's going up. You've got a property, it's going to cash flow. Whether it goes up or not is really irrelevant. It's going to give you cash flow. Leverage is going to give you an increased return on investment on stuff. Plus, it allows interest deductions, and you got the tenants, your mortgage pay down. So the thing doesn't have to go up. If you bought at 50% loan to value, maybe 10 years later, 20 years later, it might not have gone up at all, but you doubled your money because the loan has now been paid. All right. Depreciation, you've got that, so you've got a tax benefit. Appreciation is something I was taught never to bank on, but it's going to happen over time. All right. One of my wonderful friends, unfortunately, he's become an angel at this point, great mentor of mine. You know, he used to just say real estate's not a get rich quick scheme, it's get rich slowly but surely scheme with one golden rule: don't get yourself in a situation where you have to sell in a recession. So I'm going to say that I've been watching what we're doing, once again, January 2025, and we've got people, I think we've got a bunch of people since the last recession. Real estate's done nothing but go up. With the interest rates the last year or two, we've had some stumbling and some changes there. But what I'm going to say is, if you're buying residential properties, 4 units or less, you're in a situation where you've got 10, 20, 30, 40-year money on that stuff, loans of those terms. You know, commercial stuff, you might have a 7-year loan on it. Now, I'm having more conversations with people that say, look, my current loans, I've got this big multifamily project, my current loan's at 2.9%, and it's coming due next year, and I'm going to have to replace it with a loan that's 7%, and the whole project, it doesn't work. And worse yet, I might be in a situation where I've got to make a capital contribution to actually get that loan replaced. So we've got people that are in situations where there may be in a forced sale transaction. And I would just advise you to understand, look at these things and really plan ahead. Take the time to look at your situation and understand where you're headed with stuff. And really what we're seeing in the market today is, every time the government starts talking about interest rate drops, the market stops. And because everybody, well, gee, I want to wait till it drops. Well, you know, I'm just going to caution you, don't sit around and wait on something. For example, in the IRA 401k world, when we're setting up a transaction, the toughest thing for people is to look at a transaction and say, well, gee, I've got a loss on this stock. They need to go to cash to set up the self-directed account. So they you know, we get the account set up, now we got to fund the account, and they're sitting there maybe on some losses they don't want to realize. Now, whether you realize the losses or not, they're there. So I'm going to tell you, it's no different in real estate. If you've got something that's not working for you, whether it's gone up or down, maybe you have a loss on that thing. You're saying, well, gee, I can't sell it now, I've lost some money. Well, what's going to make you whole faster? The thing that gave you the loss or something else? So, you know, an IRA 401k is a vehicle that minimizes the cost to get out of what you don't want into what you do want and keep growing that thing. 1031 is the exact same thing in real estate. So what's gain? Why are we even talking about this? Gain is just simply the adjusted sales price minus your basis. Your basis is the purchase price plus capital improvements minus depreciation. The quote unquote purchase price is going to vary depending on how you bought the property. If you've been doing an exchange, every time you do an exchange, you've got a basis carry forward scenario. If you, let's say your first investment property, which it is for a lot of people, is a primary residence, and you maybe bought or sold them prior to 1997, you had the 1034 rollover. So that was, once again, a basis carry forward transaction. If you had a, you know, let's say a governmental entity, whether city, state, fed, somebody, you know, condemns property for path of progress or something, let's say. Well, that's section 1033. That's a basis carry forward. If I, you know, passed away and you inherited a property from me, you're going to get a stepped up basis. If I gifted you a property, your basis is going to be what my basis was. So obviously that initial quote unquote purchase price varies dramatically depending upon how you bought that property. Capital improvements. So the basis is the purchase price plus the capital improvements during the time you owned it. Now, every dollar you put into something is either expensed or capitalized. If it's expensed, you wrote it off. If it's, you know, it's capitalized, it's going to increase your basis. Finally, you've got depreciation. And in depreciation, I'm just going to caution you, it's not optional, all right? So if you've got a rental house and you've been renting it for the last few years, and you've decided, you know, maybe you're doing your own tax work and you didn't take depreciation on it, you need to be aware of the government's position is you should have taken it, therefore you did. So depreciation is not optional in that situation. Now, if you just bought this quote unquote investment property, investment house, and it was never rented, then you don't have to take depreciation. But if it's rented out, you've got that depreciation schedule. So, let me ask you this. If you're looking at depreciation on a property, if you go buy a rental house, let's say it's a $500,000 rental house, who makes the allocation between dirt and the improvements? Is the improvements worth 300,000, 400,000, 100,000? What are they worth? And if you increase the value of those improvements versus decreasing the value of the improvements, what happens to your return on investment? You increase the value of the improvements, you got more depreciation to take, therefore your return on investment is going to increase. So who is making that allocation with you? And once again, that's where a great tax person is going to sit there and talk to you about that. Or if you're doing your own tax work, or I'm not going to pick on TurboTax, but how do they ascertain what that allocation is and what's going to help you? So I think really good tax people are critical, and you can also work with your financial advisors on this stuff too. So, really take advantage of the resources in your world, but understand what's there. So you're going to take the gross sales price, take out broker's commissions, title escrow fees, tax and legal fees, hour fees, and whatever that adjusted sales price is, you're going to subtract the basis from, and that's going to give you the gain. Now, phantom gain is a situation where if the debt on a property exceeds the basis, then the debt in a foreclosure or short sale, that debt would be treated as a sales price, and you could have gain on a property that you lost even to foreclosure. Now, if it's a primary residence, you've got some tax relief there. If it's income properties, you don't. So it's really important to understand anytime you're getting rid of a property, whether it's voluntary or it's involuntary via the condemnation. Not condemnation, you have 1033, but let's say through foreclosure, then you're going to have this phantom gain potentially there, and you need to make sure. It's sort of funny, not funny, I shouldn't say funny, strange when we're doing a phantom gain transaction, because what happens is the property is conveyed to us pre-foreclosure. So when it's foreclosed, it's ours, it's not the taxpayer. Now, typically you're thinking, well, gee, David, I don't have any money. I didn't get any cash. How can I have any tax? Well, the gain's subject to debt relief in that transaction. So we're not getting any money. And what has to happen is in that scenario, people have a choice. They're going to either lose the property, foreclosure, and have tax exposure on any gain there. So they could lose up to, we've got a slide ahead that's going to talk about the levels of taxation. But I mean, you might lose 40% in tax on a phantom gain transaction. Well, instead of doing that, maybe you reach out to us. We structured the exchange so that the property's transferred to us pre-foreclosure. That transfer starts the clock. And now there's things in the institutional real estate world, Delaware Statutory Trust, for example, where there's 80% loan to value. They call them zero coupon offerings because they don't give you a monthly check in the mail, but you're going to have this asset through that 7-year term, roughly 7 years typically. And at that time, you're going to have a buildup in equity. But the great thing about it is instead of paying 40%, you got a choice. Come out of pocket 4 out of every 10 in gain for nothing just to pay the tax, or you come out of pocket 2 out of every 10 and you get something that defers it. So you're paying literally half as much getting something for it, or you pay twice as much and get nothing. So it's a pretty easy calculation for people that are aware that that's a potential issue there. Now it's something that hopefully now we're into 25, hopefully the market's going to start increasing, continue to move, increase market velocity, and hopefully the loan world will stabilize a little bit. We'll have people able to get where they want to go. So hopefully this phantom gain thing's not a topic I have to talk about much, but it's just something to be aware of. These are the tax rates, right? Now, I really get tired of people saying, well, gee, you got to pay your fair share. Now, this is long-term capital gains tax rates here that we're looking at. Now, if you look at normal income tax rates, so an asset held for under a year or held for resale, you're looking at maybe a max Fed rate of 37% instead of 20 and 25. So it makes a huge difference there. Then, I'm talking to you from Oregon this morning, and our state rates can be, up to 12%. Washington State at this point in time, if you're looking at real estate capital gain, you're not going to have any tax there. But if it's a sale of shares of something, you're going to have capital gains tax there. And then if you make enough, the old Obama healthcare tax, another 3.8 gets put on top of everything. So if you look at this, it's very easy for you to be, just on appreciation, you're looking at 20% Fed, depreciation 25% Fed. State can range from anything from a few percent up to, New York. I think New York's the only one that's charging more than Oregon if you're in the metro area with the, the homeless tax and everything else, where if you're making millions there, you could be in excess of that, 12%. But, do the math, it adds up pretty darn quick, and you can be up to 50% if you, start looking at some other issues there. And that's assuming it's all long-term capital gains tax rates. So it gets ugly pretty quick. This is just a map showing state by state. If you look at this and you ask, hey, David, where are people going with their money? Well, they're going to the gray states, all right? Zero tax states. And typically those states are also going to be states where you've got more rights of ownership. So there's a lot of, let's say deep blue states these days where you've lost total control of your property. The tenants have it. The politicians continue to mount the tenant rights and take your rights away. So it's really sort of a tough thing. So we have a flight to, let's say, quality, whether it's a reduced state tax rate or a situation where it's increased ownership rates. Now, looking at this map, I want to caution you that years ago, okay, it was possible, let's say I'll just say for Oregon and California, for example, you could have exchanged out of one of those states into, let's say, Texas, held the property for a year or two, and then sold it and triggered gain in Texas, which you would have saved yourself anything from the 13.3 max in California or up to 12 in Oregon, and you're in a situation where you would have gotten rid of those gains, so you would have saved that much money. Well, that doesn't work anymore. Oregon came up with a clawback, and then California said, hey, that's a great idea, we're going to do it. Other states are figuring this stuff out too, and they just don't want to lose their state gains. So basically what happens if you exchange out of some of these states now, you can defer your gain as long as you continue to do exchanges. But if you have a future taxable sale, they're going to want to claw back what was deferred out of that state, and they keep track of what you're doing in that you have to file annually with your tax return some statement stating you haven't sold one of those properties you exchanged out. So just be aware of that. At least the way it is today, you're going to maintain total deferral as long as you continue to do exchanges. But if you're looking at just doing an exchange out of a high tax rate state into a zero tax rate state, a lot of these states are figuring that out, and they've got a tool to get what was originally deferred out clawed back into them. Exchange fallacy. So a lot of times you talk to somebody and they say, well, gee, you shouldn't do an exchange because of this or that, or the exchange says this or that. And I guess one of the things that's coming up more and more again right now too is people saying, well, gee, real estate's been tough lately, or the interest rates are hard, the properties don't make sense. And somebody will say, maybe you talk to your financial advisor and all of a sudden you're saying, well, gee, we'll just sell and pay the tax and put it into Wall Street because Wall Street's going to be great. Well, understand that if you go back a couple of slides, we just talked about the fact you could have as much as 50% of your gain lost to tax, but typically we're going to be maybe at that 35 to 40% rate. So I'm going to just ask you this question: how long is it going to take you to make back the 35 to 40 you just gave away in taxes? So I'm going to say, instead of just selling, paying the tax and putting it into Wall Street, I'm going to maybe suggest buy a couple different properties, buy one of them outright after you've completed the acquisition, do a cash out refinance, take that money and throw it into Wall Street. And now you're not losing that 40%. Now you're saying, well, gee, there's a cost of the refi, and I'm going to have some equity in there. Yeah, but what is the max loan to value? Let's say you're at 60%. Well, instead of just selling and not having the property to get the access to the money, now instead of having the 40% loss of taxes, you got the 40% in that property still, and it's still working for you. So it's the opportunity cost there. You got to look at any time you're doing this, whether it's the opportunity cost of the exchange forcing you into buying something within that 45 180, or it's the opportunity cost to take that money and put in Wall Street. Don't just say, hey, I've got to pay the tax to get the money for Wall Street. Look at other options. Do the cash out refi. Talk to and that's why I said earlier at the top, a good financial person is very important to you, because they are going to be able to help you out and say, well, gee, as far as 1031 compliance is concerned, I don't care. You could close a purchase and 2 weeks later do a cash out refi. I don't have a problem with that. I don't see a tax risk or a defendability issue with the 1031 to do that. You can't have it as additional function of closing. You can't have money sitting there. Holdbacks are a problem, but you can't have a closing and a refi all at one closing. That's not okay. But to do it later is fine, even a couple weeks later. But make sure you talk to your tax people to understand what is going to be required for them to get you that cash out refi, what timelines are there. And then once again, the opportunity cost of that is you got money locked up for that period of time. Just for example, like the opportunity cost of converting an asset from investment to residence or residence to investment for 1031 or 121 reasons, there's always going to be a seasoning period there. And that seasoning period is the quote unquote opportunity cost. So, lots of things to think about. And I would say a lot of times people just don't know what they don't know, and so you start asking questions. So these are common fallacies. Like kind, years ago people say, well, gee, I remember it was house for house, land for land. It's never been that way. So like kind refers to the nature of the investment rather than the form. Any real property held for investments, like kind with any real property acquired with the intent to hold for investment. There's there's no required 2-year hold in 1031. Now, one of the most viewed videos we have on our YouTube channel, by the way, if you're having a hard time falling asleep some night, type in on YouTube Equity Advantage 1031. You're going to see hundreds of videos up there on all aspects of 1031, but you're going to see videos up there on everything from life contracts to structured sales to cost segregation studies, qualified opportunity zones, all kinds of stuff up there. So a lot of them are 1031 related, but a lot of them aren't. And people might say, well, gee, why do you have something on an OZ when it's sort of in opposition 1031? Well, maybe it's a fallback for 1031, or maybe you're just looking for something else to do. And we are an investment-based company, so we want people to understand what their options are and make sure they're getting where they want to go. I'm not in a situation where I've got to do your deal today to survive. Okay, we want to make sure that we can help you get where you want to go, and sometimes the exchange is not the right thing. All right, so one of the most viewed videos we've got on there is the fallacy of the 5-year hold. That's a result of people kept reaching out and asking 5-year. It says 5 years. Well, it doesn't say 5-year. 5-year hold with respect to 1031 has to do with something called the Housing Assistance Tax Act and tax treatment of what's going on. We had a 5-year hold got put in place with one of the tax reform issues, the early 2000s, because they saw people exchanging out of an investment into a quote unquote investment. They'd buy the property, and there was a window of opportunity right after 1997 when 121 replaced 1034, where you could buy a property, convert it into your residence, maybe a year after acquisition, live in it for 2, dump it, take the exclusion, get rid of all the gain. That does not work any longer. First thing government did was put a 5-year hold in place, and then that didn't slow it down enough, so they put the Housing Assistance Tax Act of 2008 in place, which sort of shuts the door on that. So the 5-year hold was a result of those issues that came up. But as far as 1031 is concerned, there is no stated required hold in Section 1031. The 2 years applies to a related party transaction. So if you want to exchange between related parties, then you've got that 2-year hold is one of the issues to look at. We've got some things that typically you can sell to a related party in exchange, and that's not going to apply. But buying from a related party is not okay unless each of you do an exchange and each of you hold your respective replacement properties for no less than 2 years. 3, there's no limit to the number of properties relinquished and received. The identification rules sort of imply that there are, but there's no limit to what you can relinquish and receive in an exchange. The ID rules do apply. You've got 3 different identification rules we'll talk about a little bit later, and they can become cumbersome and they can be painful. But my advice is, if you're going to buy 50 properties, let's say in a replacement, let's get the deal done inside the 45 days, so the identification rules don't even apply. 4, you can carry a note or land sale contract, still do an exchange. So we had probably a decade or so where we wouldn't see any of these transactions. In today's world, we see lots of seller carries, and you can do an exchange with them, but it has to be structured prior to a close. If you sell and carry a note and now you've got a balloon payment coming in, you've got a problem. So we've got ways to deal with this note. We're going to talk about that a little bit later. Another issue that's really coming up a lot these days is loan to value or debt in an exchange. A lot of times people say, well, you have to replace debt in a 1031. Totally untrue. Totally untrue. Debt can go away two ways, one by going down in value, the other is by adding cash. Adding cash is always fine. So if you talk to your lender and say, hey, the LTV on the new property is not going to be what the loan to value was on the other one, and we need you to inject some money, and you're thinking, well, gee, I've been told I've got to replace the debt. That's not true. You can offset mortgage boot, a reduction in mortgage with cash. You cannot offset cash boot, cash received with mortgage. So you can always add money to a deal. That's not a problem. So like I said, debt can go away two ways. One by going down in value, which triggers tax because you went down in value. The other way debt goes away is by adding cash to that transaction. And then finally, 1031 is not all or nothing. So every dollar you spend over the basis represents tax deferred gain. It's up to you to decide when that ceases to make sense. Maybe you've got some losses that can offset some of the gains, so look at that situation. So that's one of those planning issues. Talk to your tax people, talk to your financial advisors, look at what's going on in your world when you contemplate a sale. Then you can make that right decision. So I just mentioned conversion of property, right? We talked about converting investment to residence, residence into investment. There's reasons to do both of those things. So if we're looking at a transaction where you say, gee, I'm tired of income properties, I just want to go buy a place at the beach to retire into, well, you can do that. So I'm going to tell you to hold it probably a year or more, a year, because it's been proposed several times for 1031, and that's the break between short and long-term tax rates on assets held for investment. So if the Internal Revenue Service says a year is where that break is for an investment property, we'd argue with them, right? So I would say that there's a court case where 4 months was deemed long enough. It's up to you whether you hang your hat on that. But I think a year is fine. If you're dealing with related party stuff, then you're looking at a 2-year issue. But I will caution you, if you're going to do that exchange into a property, you convert it into primary residence, do not sell it within 5 years of acquisition. You're going to have a big tax hit. Even after 5 years, you're going to be subject to Housing Assistance Tax Act of 2008. So you need to sort of really do the math, figure out the numbers on what you're going to satisfy. So what I tell people when they want to buy a property, convert it into primary residence, I say, look, do that deal with the idea you're going to be living there into perpetuity. Don't do it with the idea I'm just going to get rid of tax, because that really strategy doesn't work any longer. So that's a reason to convert investment to residence. Well, why would you convert a residence into investment? Well, how many times today, if you look at Section 121, the universal exclusion, that was put in place in 1997. That gives an individual $250,000 exclusion on gain, a married couple $500,000 exclusion. How does that help you today? I mean, when you've got gains, it may be in excess of millions of dollars. I would argue the 250 or 500, if you go back to 97, what a home costs today versus what a home costs today, I mean, it's just worlds apart. So I would probably argue that today it'd probably be $1 million, $1.5 million, or even more what those exclusion numbers should be. Now, like I said, we just had a legislative update last week with somebody that's, paid to be a governmental affairs officer for one of the largest real estate firms in the country. And he's saying they're not, that the conversation on increasing the 250 or 500 hasn't crossed anybody's desk. Now, I really think that's strange and interesting at the same time. Why isn't anyone talking about this? Because it's really, you think about how many times you got to pay tax on stuff. Like I said, death and taxes, sure, you pay tax on money when you make it. A lot of states, you got sales tax. You pay tax on things when you buy stuff. If we're talking real estate, you're paying tax on the property during the entire time you own it. When you go to sell it, you're going to pay tax again. When you pass away, you get to pay tax again. I mean, how many times are you going to pay tax on this stuff? So really look at that and understand what's going on there. But that 121, that 250 or 500 is just woefully inadequate for today's world. And so there's lots of times where we'll have somebody move out of a home, and then after a reasonable period of seasoning, and it doesn't have to be rented out, you just work with your tax people, make sure they're comfortable with what you're doing. And maybe it's a year you haven't lived there, established residency in someplace else. When you sell it, now you're entitled to exclusion. As long as you sell it within 3 years of moving out, you're still entitled excuse me, to the 250 or 500, and then you exchange the overage. So you can take a huge tax hit and get rid of all of it by converting those things. So there's reasons to go invest in a residence. There's reasons to take residence go investment. I guess another comment I've got, you can have a common investment that's got both too. So an obvious example would be a duplex half owner occupied. Less obvious example, one that's probably biting people today, you probably got to get audited to get bit by it, but it's a home office. Your tax people might say, well, gee, you're working out of home after COVID, and I just watching a lot of these politicians are now dragging our public employees back into office on stuff. Otherwise, they should sell the property, honestly. But if you got a situation where you have a home office now and you've been treated as such for a number of years, when you sell your home, that home office needs to be 1031 exchange. A less obvious example would be a home on acreage. You've got the home, or maybe it's on a farm. You've got the farmhouse, you got the working land. So there's lots of situations where you have a single sale with allocations, investment, and residence. And once again, it's come back to you. How do you make those allocations? You want to take full advantage of that Section 121 for the primary residence, and you want to minimize any tax exposure. So numbers are going to go up or down depending on where you are and what those values are, and you're going to work with your tax people to justify those values. But once again, these are tools, and when they look at 1031, a lot of times people will say, well, the government has come back over and over again through the years. Well, it's for the wealthy. I would say 1031 is the one, let's say, tax benefit that's easily applied to anybody's transaction. I mean, it's one for the everyday person, everyday investor, because the cost of the exchange is so nominal. Even if you look at let's say a DST deferred sales trust, I mean, there's cost to putting that thing together, all right? But a 1031 on a basic transaction is a grand, let's say. So that's nothing in the grand scheme of things. I mean, even if you're doing a reverse exchange or an improvement exchange, maybe you're at 5 to 10 grand for one of those. It's really just such a nominal amount to get you where you want to go, and anybody can do it without having to have specialized tax and legal counsel involved with the thing. So that's why you're looking at, understand the options, understand you can convert things, and you really look at, what you've made and how you're going to keep that money working for you going forward. And there's reasons to do both those things conversion-wise. This page, the seasoning page, we've already addressed. I'm not going to go any further with it. This is the first presentation of the year, and I'm running over as usual, I can see. So sorry if I'm talking quickly. I did whittle down a bunch of slides, but we got a bunch to get through. This one, the seasoning, we've pretty much covered everything on it. This receipt case is the one I'm talking about, very abbreviated hold period. Understand what's there. You can talk to it. If you got questions, give us a call on it. So the exchange, all right, literally, if you're looking at a 1031, you sell what you don't want, buy what you do want. You're paying us a fee to structure that, turn that into an exchange. I like simple, so we look at 4 basic cornerstones to it. And I'm just saying, one, it's got to be an exchange. Something's got to be given away, something's received, and it doesn't. A true exchange is you've got something I want, I have what you want, we swap. Okay, that can happen. You don't need us to do that. That can be done with a swap agreement. Your lawyer can put it together. We put them together for people, but that's not that's just a true swap. That's not a quote unquote tax deferred exchange in today's context. Tax deferred exchange in today's context is you're paying a third party accommodator, facilitator, intermediary, somebody like Equity Advantage to turn your sale and purchase into an exchange. And as I said, this is the process really was the last formal guideline really was 1991. We've had revenue procedures and other things with respect to, like I said, the Housing Assistance Tax Act, or in 2000 we got the safe harbors for reverse exchanges. But really 1991 is where all this stuff was really sort of nailed down and put together. So it's not new. The exchange process is over 100 years old at this point. So it's something that's not new. It's well established, and it shouldn't surprise anyone. But unfortunately, people still call us after something's closed, wanting to structure an exchange. So one, it's got to be an exchange. Two, what's going to receive got to be of like kind. Remember, nature rather than form. For total deferral, you need to satisfy what we call the napkin test, which says you've got to go across or up in value and equity. Once again, value and equity, not that debt. So you don't have to go across or up in debt. All right, the debt can go away two ways. One by going down in value, triggers tax. The other is by adding cash. So we like to say you're going across or up in value and equity. Forget the debt piece. Finally, you've got to have continuity vesting. That just means that the person or entity that gave us something has to be given something back. And where we have the biggest issues with that is limited liability company, multi-member limited liability companies, because partnership interests are specifically prohibited from 1031 treatment. And the other issue that comes up with this vesting component is financing, right? So if we're looking at 4 units or less residential loan, typically financing something like that's more expensive for a limited liability company. If you're living in a, let's say, a non-community property state, even a limited liability company with 2 spouses in a non-community property state, that's a legal partnership. We can't have them relinquish a property in an LLC and buy personally. Now, if you're in a community property state, you can relinquish in an LLC and acquire personally if the multi-member LLC is spouses. Now, other than that, if it's a formal partnership, let's say I go out and buy something with you in something, we do it via an LLC. 5 years, 7 years from now, we want to go buy something else and we want to go different directions. We've got to break the entity to do that. So we got to do it. A drop and swap is a break of the entity predisposition. A swap and drop is a break of the entity after acquisition. So that's the biggest headache with anything in 1031 world is time. The second biggest issue is vesting. Like kind, wide open. You can go from land and apartments, office buildings, strip malls, place of beach, retire into. All those things are going to be of like kind. If you look at that 10 o'clock button, even a 30-year leasehold interest in real property constitutes like kind property. So a lease at 30 years duration or with extensions to 30 years constitutes like kind real property. The napkin test, as I said, across or up in value and equity. If you look at the middle of that in bold, we talk about the debt and how it can go away. It's not all or nothing. So if you want to pull 10,000 out, go take a trip, you do that, you can have exposure on the 10,000. I said exposure, not taxes owed, because maybe you have stock loss somewhere else. You sell that stock off pre-year end, so you offset the $10,000 in boot with a $10,000 loss, and you have zero net tax. So once again, work with your tax people. Tax exposure is one thing, taxes owed is another. Take advantage of the people you pay money to in this world. Get good people and listen to them. They can't help you if you contact them, January of the next year, because it's too late to sell and realize losses. It's too late to deal with some of these things. So really take advantage of the people pre-year's end. Don't just reach out to your tax people at year's end or pre-tax return time. Talk to them before you ever sell anything and understand what's going on there. But the napkin test tells us what we have to do for tax deferral. Continuity vesting, the person or entity that gives us something has to be given something back. And as I said, limited liability companies with spouses in a non-community property state can be problematic. Community property states are fine, but multi-member LLCs, legal partnerships, we've got a situation where we can do an exchange for the entity, but you can't do an exchange for the members of that entity. So you either break that thing, maybe a year predisposition or a post-acquisition, but that's one of those planning issues. You really got to look at what you do, and that's one of the benefits of tenancy and common ownership versus multi-member limited liability company ownership of a given asset or group of assets. So partnership exchanges, drop or swap, swap and drop. 9 times out of 10, people don't think about this issue. So what happens is, I'm going to tell you, people ask all the time, when do I want them to reach out to me? I'm going to tell you when you contemplate a sale, and we're going to go through this stuff, and I'm probably going to tell you to talk to your tax people about it, understand the tax liability, then you can go forward. Now, if we have a conversation, this happens regularly, unfortunately. I might be called into a meeting and we've got a conference room full of people that have a given asset owned as a limited liability company. And my first question to that group is, is everybody going to go forward together upon disposition of this property? And if the answer is yes, then great, we'll just do an exchange for the entity when it sells in the future and they go forward. But 9 times out of 10, somebody doesn't want to go forward. Somebody wants to get out. So what we'll say during that meeting, say, okay, well, if you don't want to, the people that, if there's a group that want to go forward, we'll keep them in the entity. And if there are people that want out, we'll deed them out tenancy in common, maybe a year pre-disposition. Now they've held that property when it comes to the closing as a direct ownership via tenancy in common, and they can successfully do an exchange at that point. But what happens is we don't get the call to do the exchange or about the exchange until the deal's now got a sale pending, the deal's in escrow, and now you say, okay, gee, if you do that drop and then swap, you've deeded out that person that doesn't want to go forward or wants to go forward in something else. How can they defend that they ever held that property personally for investment predisposition? And that's where different states, if you're dealing with a state that's got zero tax, now you got maybe the federal government might be snooping around looking to disallow the exchange, but at least you don't have the state coming in also. So it makes a difference where you are, whether you're dealing with just Fed or Fed and state. Whether you want to take the risk of a drop and swap when that drop happens while a deal is pending. So what happens in that scenario is you've got a purchase sale agreement between the entity and the buyer, and now you've got to amend the purchase sale agreement to reflect it's the entity and that person tenancy in common and the buyer, and you've got escrow drawn a deed from the entity to the entity and that person tenancy in common. So that's what happens with a quote drop and swap. The alternative, let's say nobody's comfortable with that break predisposition, we're going to do the exchange for the entity. Maybe we go buy 5 different replacement properties. Maybe each property is acquired via a different limited liability company with the exchanging entity as the member. And then maybe a year after acquisition, Stevie's going to get this property, be assigned membership interest in that one. Timmy's going to go to this one. Susie's going to go in this one. Jennifer's going to go this one, and David's going to that one. So we can change ownership, convey ownership of the property via assignment of membership interest in the future. You would just want to make sure if you've got a title policy on those properties that would allow, if it's assignment of membership interest, it's going to be fine. If we're deeding from that entity to a particular investment on each one, now you got to have a title policy that's going to allow that transfer once. So you want to talk to that issuer when you're buying that thing to ensure that's possible, or you could be losing the title policy with the transfer of ownership, the deeded transfer from the entity to that taxpayer for each respective property. So, usually people want to do the drop and swap because they just they just don't want to be involved with everyone else going forward. You got different LTVs involved with different assets. And so it's more cumbersome to do that swap and drop, but they get done. And a lot of times it's a more conservative transaction than the drop and swap is. But you can see where this ends up an issue, or I shouldn't say but, you should say and. All right. When can I get my money in an exchange? This is a tough deal today. All right. So understand you set up an exchange, there's an opportunity cost. You're married to us for 45 days. So from the date of settlement, we can only distribute funds when you've purchased everything you have the right to buy, which means at no time inside the 45 days. After the 45th day, we can give you the money after you've acquired all property you have the right to buy. So if you identify things, don't identify more than you want. Identify only what you want or to buy, or if we're in a situation where you're identifying multiple properties with the intent to buy one, our identification packet includes a blank you can fill out stating that I'm identifying, let's say, 3 properties with the right to buy one of those. So as soon as you bought the one, let's say we're on day 60, and day 61 after that thing closes, now you're able to, you can only get the money after you purchase everything you have the right to buy. So don't get, and by the way, if we get to the day 45, don't identify something just in case. Only identify something, if you intend to buy it, because what will happen is that if you identify something just in case, and let's say you're now on day 65 and you find what you really want, I can't give you the money. So really the 45th day, it's a hard stop. If you don't know what you want, terminate the transaction. If you've identified something, rescind the ID, we'll get the money back. If you are buying something but you want to take some money out of the transaction, then understand that we can only give you the money after you've purchased everything you have the right to buy. So this is something that just comes up these days because we've got more transactions that are a hard time getting where they need to go. Notes in an exchange, seller carries. We've got a variety of ways to do that. One, that note, just like the cash has to come to us at close, the note has to get to us at close. Then we've got some choices. We can sell the note to a third party. We can be in a situation where the property's going to be a short term. Maybe the property financing on the property blew up and you still want to go forward with the deal. Maybe that's the case where you're accommodating a buyer's, the seller carry for the buyer. Maybe it's a situation where the property's not financeable. So a short-term seller carry, we wait till the note balloons, we've got the cash to complete the transaction. Maybe you're in a situation where you do a partial exchange. You're just going to defer gain on the initial purchase or the down payment and pay tax on that note over time. All those things can be possible. I guess a couple words of caution on seller finance. If you just think it's an end game for you, understand. A lot of people think, well, I'm just going to pay tax on the principal payments as they come in. Long-term capital gains tax on the principal, you're going to pay normal income tax on the interest payments. But understand that if you've got an encumbered property that had depreciation on it, even if you don't receive a single payment in that initial sale year, you're going to have tax on debt relief and depreciation recapture, whether you receive a single penny of down payment. So you really need to understand the tax liability, when you're going to have that tax liability. If it's an end game for you, understand those numbers and decide what you want to do. But understand, one, that these things, if you sell and carry paper, your tax liability is cooked if it's not set up as an exchange of settlement. You can't do the exchange when you get the balloon payment. Number two, understand what that, the tax consequence of carrying paper is. And number three, if you want to do an exchange and you're carrying it, we've got these options. 9 times out of 10, what happens is our client buys the note from us, completing the transaction. So as soon as they buy the note from us, we've got cash. And you say, well, gee, David, why would I buy my own note? Well, you're really doing substituting cash for the value of the note. So now you got a note that's paying you 6, 7, 8%. By the way, if you're carrying paper too, and if money through a lender is going to cost 7%, don't carry it at 5. I mean, you should be getting 10 out of it probably, or more, depending on what it is. But that seller carries there for a reason. Don't do it at what a current market rate loan is through a broker, unless there's some reason you want to do that. But it should be more. So just be aware of that stuff. But if you're carrying paper, give us a call. Go through what your options are, understand the liabilities, and we can do the transaction. So one of the big fallacies, you can't carry paper, do an exchange. You can do it, and there's a variety of reasons to do it, and there's a variety of ways for us to get it done. Notes in reverse exchange. So obviously we don't have time to cover reverse exchange. I don't have time to cover the delayed deal today. But in a reverse exchange, if you've got the financial ability to buy a property today to replace a property yet to be sold, we can do that via reverse exchange. Once again, don't close on it before contacting it. It's got to be structured as an exchange. You cannot own the new and old property simultaneously. So if typically what happens with a reverse exchange, you're going to show up at the purchase replacement property with the cash required to buy that property. We are going to sign a note that say we borrowed that money from you. The note's secured by the property. When your property sells in the future, the proceeds come to us. We use those proceeds to repay the debt we have to you. Okay. Now, if you carried a note trust deed on, and by the way, buying on a seller carry is always fine. Selling with a seller carry, that's where the issues come up with a delayed exchange. With a reverse exchange, it's not a problem, because when we buy that property, once again, we've signed a note. We borrowed whatever the down payment was for that property. We have a debt to you. When you sell that relinquished property and you carry a note, that note comes to us just like cash. We can use that note to repay the debt we've got to you. So even though seller carries in a delayed exchange are very problematic, seller carries in a reverse exchange when you're relinquishing are not a problem. And we can work through those things. So I think that's just something that really, it's fun to go through and have people understand how we can work that out. Timelines in reverse, just like the delayed, you got 45 from the date of acquisition ID, what's to be sold, 180 days to actually sell that property. Or a delayed, we've got that 45 from settlement ID, what we want to buy, 180 days to actually buy what we're going to buy, or that due date of the tax return. getting started with these transactions. So we've talked a lot about structure, why to do it, how to do it, the tax liability, all those basics of 4 cornerstones. And at this point, you're probably doing, gee, David, get to the bottom line. How do I have to do, what do I have to do to make this happen? Well, list the property that you don't want as you normally would. Okay, if you're looking at finding something, a lot of times people negotiate a purchase. You can go ahead and negotiate the purchase before the sale happens. That's all fine, but you just want that timing issue is going to be critical. Don't do it just because reverses are there. Don't do it reverse unless you have to, because there's the cost of the transactions may be 5-fold what a delayed exchange is. So just because it's there doesn't mean you should use it. But once again, the cost, even a reverse, is pretty nominal amount, and it can help you get where you want to go. But before you close on anything, make sure it's structured as an exchange if that's what your intent is. Now, list the property you don't want as you normally would. All right. Now, most state forms include a cooperation provision in the purchase sale agreements. It's sort of boilerplate there that allows you to do an exchange at any point, to elect to do an exchange. Now, the problem with that boilerplate is you're not letting anybody know that you're going to, or telling them that you're going to. So if you just simply rely on a state purchase sale agreement form that includes that boilerplate, now you've got escrow open and the deal gets closed without getting structured as an exchange, which, by the way, happens all the time because nobody lets anyone know what they're doing, or is told that they've got to get it structured before close. Make sure when you're having your first conversation with your broker that you're letting he or she know that you want to do an exchange. And then when you've got a purchase sale agreement in place, include something stating that your intention is to do that, you are doing an exchange. So you could put something as basic as buyer agrees to cooperate with seller's 1031 exchange at no additional cost, liability, or obligation. Something like that would take care of it. Now you've made it a contingency of the closing, so escrow knows it's going to be that way, and you're not going to have a problem with it getting closed. Where if you're just relying upon a form, a boilerplate clause in the purchase sale agreement says you have the right or the option to do it, nobody's telling anyone that you're going to do it, and it could get closed. Now, if you don't have a 1031 clause and you didn't put it in there, and the form that you used did not have that boilerplate that you have the right or option to do it, as long as the purchase sale agreement has a right of assignment clause in it, that would allow the assignment to occur whether you have any 1031 verbiage in that purchase sale agreement or not. So, 1, contemplate a sale, talk to your tax people, understand the tax liability. 2, if the tax liability is great enough and you want to do an exchange, when you list the property, make sure your broker knows that. If you're making an offer on a purchase property, make sure your broker understands what you're doing. All right, make sure they understand it's an exchange. Now, if you're just a broker and you're on this call, if I go back to the early 90s, there are a lot of people. I mean, I remember digging through MLS books and looking for the 1031 clause, or not clause, but that it was to be a 1031, and a lot of brokers would avoid those people that were in 1031s. The old saying, buyers are liars. Well, if you're in a 1031, if you're selling a property to somebody in a 1031, you've got a motivated buyer. All right. So if I just walk off the street and make an offer on your property, if I don't like it at any point, I can just walk away. As long as I've got contingencies and timelines and so on and so forth, I can get out of there. And a lot of times keep my earnest money mine even, right? Unless I've released it. If I'm looking at, so there's very little cost to me to walk away. If I'm looking at selling somebody that's in an exchange of property, they potentially have a huge tax liability if they don't buy it. So I'm going to tell you, if the listing broker, somebody's coming in and making an offer on your property in a 1031, you probably want to know where they are in the 45-180 and what else has been identified, and that's going to give you some leverage there. On the other hand, if you're a buyer's broker working with your 1031 client, you don't want anyone to know where you are in the 45-180 and what's been tied up or what you're looking at, where that property is in choice 1, 2, 3, 4, 5, 6 on the ID form, whatever it might be. Now, identification does not mean you've got a purchase pending. It just means you're giving what the government deems an unambiguous description of the property or properties you intend to buy. That could be a common address, including city, state, and zip. If you're going to buy with somebody else, you need to ID the portion you intend to buy. Okay, so you can't just say, okay, I'm buying number 1A Street, you're buying it with 3 people, you're picking up 20% of it. What you received has to be substantially the same thing as what you've identified. So if you're picking up 20%, you ought to write, you're identifying 20% of that property. If you're looking at identifying more than 3 properties, the ID form is going to require you to put a value on that thing too. If you're buying into a Delaware statutory trust, a DST, for example, or institutional TIC, you need to identify the portion of that offering you're picking up. Maybe the interest, the percent, maybe the cash that's going into it representing your interest. All right, so just be aware of those things. But you think about the exchange when you contemplate sale, talk to your tax people, talk to your broker, list the properties you normally would, let them know you're doing the exchange, sell as you normally would, get cashed out on. As soon as you got a sale pending, escrow's open, we're going to want your name, address, phone number, email address. We're going to want to know who's handling the escrow number, and a phone number, and email, where we're going to reach out to them. If you don't have an escrow number, maybe it's the property address and buyer's name. We're going to reach out to escrow, get a copy of the purchase sale agreement, title report, and then we're going to draw up all our contracts. Just for the sake of time and the presentation, we're going to say we're going to create the 1031 exchange agreement. We're going to create an assignment agreement. That agreement is what allows us to assume all rights and obligations of taxpayers as seller of the relinquished, buyer of the replacement property. We're going to create escrow instructions. You, the exchanger, are going to get copies of all those in advance. You don't sign anything, pay anything till close, and only if it does close. All right. So everything, the originals will all be at escrow waiting to be signed at time of settlement. All right. So at closing, you're going to sign read and approved as exchanger. We sign as seller of the relinquished, buyer of the replacement. The proceeds come to us. Once again, if a seller carry, that note would come to us. And then we're going to have that 45-180 start, work through all that. Now, if you found the replacement property already and you've made an offer, and let's say you've put earnest money down and we haven't closed on your relinquished property, you can put the earnest money down. You just let us know whether you want to be reimbursed that earnest money when we go buy that property for you. That same thing could apply even if we have your earnest money. It's going to take us probably 48 hours to forward earnest money on a given investment for you, because we have to draw the assignment, get it signed by everybody. But we can forward earnest money if we have your money. We can forward earnest money on your behalf. On the other hand, if time was of the essence, you had to put the earnest money down, you can do that. We can reimburse you the earnest money when we go buy that property. All right. So phase 1 is what you relinquish. Phase 2 is what you acquire. And we just want to know, as soon as you got purchases pending, sales pending, anytime you've got anything going to escrow, we want to know about those transactions. Get our paperwork together. Sometimes we might sit on, if we're in a situation where we don't know if it's going to be delayed exchange or reverse exchange, we might sit on contracts until we get within a couple of weeks of close and we know where we're going with it. But we don't have a cancellation fee, so don't worry about getting us started on something and then you're stuck paying us something. You don't sign anything, period, with us until closing, and we don't have a cancellation fee. The reason we don't is we don't want you waiting till the 11th hour to tell us go, because you're worried about incurring a cost there. So if it's closed, then we're going to be paid the fee to structure that thing. Few examples and we're out of here. All right, so this is an example of a transaction with a conversion. All right, so these are people that had a multifamily project. They sold at $3 million. They bought at a $1 million replacement property. They went from multifamily into a quote unquote investment house in the desert. And ultimately they were going to convert that thing. But their situation, you're saying, well, gee, David, they didn't go across or up in value or equity. They went way down in value and equity. Well, in this situation, their basis was $250,000. So every dollar they spent over the basis represented tax deferred gain. So they deferred the gain on the difference between the 250 and the million. So they deferred gain on $750,000, saving $250,000 in tax. They had tax exposure on the difference between the 1 million and the 3 million. Now, in their situation, they just wanted the money to play and live their life. But another option that typically will happen is maybe they end up buying an institutional tenancy in common property. They're buying to a Delaware statutory trust, and so the $1 million would go to this investment house, and the other $2 million might be spent on DSTs or something like that, and give them the cash flow. Because you got, once again, understand what the tax liability is on disposition, and then you can make those decisions. But if you would just want to take the money, pay the tax, take the money, and have funny money, do it. Just know that every dollar you spend over the basis represents tax deferred gain in this situation. they still saved $250,000 in tax, even buying at $1 million, going from a $3 million disposition. This is an example, just people giving up a vacation rental and took it into multiple replacement properties. So they took a portion of the property, bought a multifamily project that was held. They took took a portion of the money and went into single family rentals. And those rentals were fixer properties. Well, fixers, there's groups, Bigger Pockets, for example, and you got lots of people that do fixers, flippers. You got your wholesalers, retailers. It didn't take me long to understand you don't want to be somebody that's buying and flipping properties, because you're paying normal income tax on the stuff and you don't have the ability to do an exchange. So instead of doing that, and I love the world of acronyms we're in these days. You got a lot of people saying, "Oh, BRRRR." Well, that's something that's been around since the start of investment real estate. So what we would do, and this is what my brother and I always did, is we would acquire a property, do all the improvements we needed to, get tenants in there, do the cash out refi, hold the property for a year or two, then do an exchange. The refi money, what was left via, after the cash out refi is really typically going to be in excess of what you would have netted after paying taxes. So you got a choice. If you want to flip a property, go for it, buy it, fix it, turn it, and you're going to be in a situation where you're giving up half of what you made. Well, if you do the cash out refi, maybe you got 30 or 40% equity in there. So you're paying less, you got less money tied up that you lost, and you still own the asset, and then you do the exchange later. So that's where people go. BRRRR is a situation where they don't take it that next step with the 1031, because at some point every property is probably going to outlive its usefulness or effectiveness. And one of the things my mentor I always joke that he always wrecked my investments, because he knew what my yields had to be, what my ROIs had to be. And after a couple of years, it's inevitable the equity in the property is going to be too much, and you got a choice at that point: do the exchange or do a cash out refi. And the decision between one of those or the other is going to be, obviously there's always the argument, why would you ever sell a great piece of property, right? But typically you're going to say, okay, has that property outlived its usefulness to me? Can I do anything more to this to maximize that value, or is it at a point in time where I need to just get rid of it, move on to the next opportunity? And that's where the 1031 is going to come into it. This is an example of a phantom gain transaction. So we've got a institutional TIC that's being foreclosed. The ownership interests were via limited liability company. So the LLC got assigned to us pre-foreclosure. That assignment started the 45-180. The reason they did that is the debt was in excess of basis, and they would have lost the property and paid tax for the pleasure of doing that. And somebody had gotten them to us. There were lawyers that understood we had figured out a way to get people out of these things without a tax problem. So unfortunately, we did lots of phantom gain transactions during the last crash. Fortunately, we haven't had that come up. I'm hoping that it's not something we're seeing in this cycle. But understand that even a foreclosure is going to have potential to trigger some tax exposure via phantom gains, and that's debt over basis. This is an example. So we talked about conversion of a property via 1031 from investment to residence on the acquisition. This is an example, and these are all transactions we did. This is an example. Years ago, we did $3 million property. The property in Los Gatos probably be worth twice that these days, or 3 times that these days. But it was $3 million gain at this point, at the point of this transaction. So they were in a situation where the exclusion gave them a $500,000 exclusion. Married couple. He was a lawyer. She was a CPA. They didn't want to pay that tax. The law firm they were working with sent them to us. Said, look, you got a choice. You pay tax on the $3 million gain. You're going to lose $1 million to tax roughly, or move out of the house. So we had to move out of the house. They seasoned it as investment. After a year, they sold the property. They exchanged into 24 different replacement properties, closed them all inside 45 days because they didn't want to deal with the 200% or 95% rules, which were really going to be tough for them to deal with. And so they went from $1 million tax it to no tax it. Got 24 different replacement properties. I think that's a great example of what's possible with good planning and taking the time to get things done. Don't get yourself in a situation where you have to make these things happen. Look at it, ask the questions up front. Don't get yourself in a box that it's hard to get out of. Last example, all right, and this is nothing to do with 1031s. This is to tease you to sign up for next week's IRA class, all right? So this is an example of what you can do with a retirement account. So these people, husband and wife, retired, came to us. They had the idea they wanted to take his and her IRAs and combine those two IRAs to buy a mobile home park. And all of that works great. So we normally would do what's called a checkbook IRA, take her IRA, his IRA, roll them into a single new limited liability company that the member is, or members in that case would be the trust company for benefit of his and her IRAs. The manager of the limited liability company would have been the two taxpayers, and that LLC would have bought the park, and that would have been great. Well, that all works as an investment. They then told us they wanted to be the on-site managers and take compensation. Both of those would constitute prohibited transactions if we're looking at pure IRA investment. So we shifted gears from what's called that checkbook IRA or IRA LLC. We shifted gears into a rollover business startup or ROBS, which is, instead of a combination of an IRA and LLC, it's a combination of 401k plan and C corporation. So we created the new 401k plan. We created the new C Corp. This funded the plan with the IRAs. The plan bought the Corp bought the park, and the taxpayers got an investment in the park. They got a job and a place to live. So that's an extreme example of what's possible if you know what's possible. So I would ask you or offer to you, give us a call if you got an idea on something. Sometimes it's, a great idea. Sometimes it's a too creative idea, but we're happy to talk to you and help you get where you want to go. Take a look at our social media, stay on top. If you're interested, if you're a broker and you need CE for this class, reach out to see more at 1031exchange.com, see more at 1031exchange.com. If you're not on our mail list or newsletter list, let us know. You can also reach out to see more at 1031exchange.com to get on one of those. Take a look at the YouTube channel, and we've got a variety of topics on, just type in Equity Advantage 1031 Exchange. Or if you've got questions on IRA 401k stuff, you can go take a look at the sister channel, the IRA Advantage on YouTube. And we're looking forward to working with you forward and looking forward to the opportunity to help you get where you want to go. One last thing I'll mention is we've got a property listing site. So if you're a broker looking for a place to get property in front of people, there's even a Haves Once section on there. Or if you're an investor looking for things, that site may contain that. There's paid listings and free listings there. And once again, I'd like to thank you for joining us today. David Moore, Equity Advantage, 1031exchange.com. And Happy New Year to you all. That's the last time I'm going to say that this year. And look forward to a great 2025. Thank you for taking the time today. And sorry we ran over a little bit. I'm obviously going to have to work on this presentation to shorten it a little bit. But hey, you get an hour and a half, I guess, in CE if you're looking for that. Take care. All my best. David Moore signing off. Bye-bye.